Right, next part of strategy development, an important way that so many people learn. One of the best ways to learn a new idea is to go and dissect a losing idea or a losing trade. And I know people don't want to do it. No one wants to take a loser and then spend some time going back over and reliving how they lost money. Of course you don't. But think of it like this. The first objective of turning a loser around, of turning a losing trade into a winning trade, is just to prevent you taking that losing trade again in future. And if that's all you manage to do, that has a massive benefit to your performance. It's taking away effectively a tax on your performance. And so if you take that away, there immediately you produce a jump, an increase in your equity. And it's the side of trading that people don't always think about. That you can actually make a lot of money for yourself by just minimizing some of the losses that you take, unnecessary losses. So let's go and have a look. How do you do this? Breaking down any kind of losing trade, turning this potentially into a winning trade. Now, like I just said, two objectives here. First up, learn how to not lose in a certain situation. That's the key bit to this. And if you're going to look at a losing trade from any other reason, it's just simply to say, how can I not get caught in that in the future? And this isn't something you're going to do on every single losing trade. Even the best trades will not work sometimes and you will lose on them. So it's not about taking a loser and then say, all right, I must work out how I prevent ever doing that again. It may well be that with some trades, doing that again is exactly the right thing to do and it just wasn't working this time. But there are going to be certain trades that you can look at and you can try and identify what was going on before you took the loss. Because that might well help you invert the idea, turn the trade around into a new strategy. If you recognize certain characteristics about a piece of movement, you might well be able to say, okay, well, I don't actually want to participate in this. So it's that differentiation to start with a trade of being able to say, this looks like something, but it's not actually as good as I think it is. And then also the ability to say, right, well, how do I turn this around? How do I look at it in a different way? This does ultimately come down to objectively reviewing what was going on and looking at the questioning that you put into this trade. So looking at what preceded the losing trade in terms of market indications, how did the market move? What did it start to look like? What caused the loss to start? So what you're trying to do is from the chart, from the view of what you have of that trade, could you pinpoint a moment or could you pinpoint a break, a pattern, an indication, something that was the beginning of that loss? And then also for the loss to happen, one, it's got to start somewhere. It's then also got to move against you. So what happens in the move? What creates the move? Is it just a misinterpretation of some information and it's gone wrong? In which case you can learn immediately from that how to better understand that information. You go and research it a bit more. It's always, loss is always pointing you to areas that you can improve from. Reasons for the loss then. How did you interpret the information that created that losing trade? What was your view of it? What was the reason that you were in a trade that turned into a loser? And asking yourself, well, is this a misjudgment of a chart? Is this a psychological aspect? Was there a desire in this trade to try and achieve something that actually wasn't necessarily there? That can help you as well. And that's certainly something that I found myself, that there are certain trades that I know, I'll get a feeling, and this is a psychological trade, I get this feeling of I need to be in this trade. Particularly a market that is steadily moving lower and lower and lower and lower. If you're not in, there's this sense of I must get in. And for me, that is a surefire chance to lose money. Now, that then creates a tactic around how to not lose money in that situation. First up, as soon as I get that feeling, that sense of I need to get involved in this, my first thought is always, how do I play the reversal trade here? And that serves two purposes. One, it opens up a reversal trade where everybody's looking for a continuation down. And two, it prevents me from doing anything other than a reversal. And if no reversal trade shows itself, I simply don't do anything, which means I prevent myself in the first instance from losing in that situation and potentially have a new trade coming out of it. That's the sort of psychological side of it. But that all comes from being able to look at a chart in a certain situation and know that this is a situation that will typically lead to a losing trade. Look at common patterns before losses, both psychological and technical. Because if you can spot those very quickly, like I just illustrated, you can then turn that around. For me, a trade that does something like this is a classic situation to get caught selling the low. Going, it'll keep going, it'll keep going. And the problem with a trade like this is the further it goes, the more you feel you need to sell it. And then if you do sell it and it doesn't suddenly put you on side, you end up looking back up and thinking, where is my stop on this? And that's an uncomfortable thing. So you can't see where to place a stop, meaning you're then going to get out of the trade very, very easily, give the trade up, and then start the process of trying to sell it again. So that's both a psychological and a technical pattern that leads me typically to losing trades, or certainly to trades that have very limited payoff, because it's very easy to get pushed out of that trade. So that's the simplicity, breaking down the fact, why does it become a loser, common characteristics to it, and then looking for access. How could you play the trade in the opposite way? And it's one of these easy things where people say, well, if I just did the opposite of what I thought, then the trade would work. The problem with that is in thinking the opposite of what you thought, you're now actually thinking about a certain thing anyway. And so if that goes wrong, what do you double back and now think the opposite of what you thought was the opposite? It's not going to work. You have to look at characteristics and reasoning and then access to the trade. Let's go and take an example. And I use this one to illustrate delta reversal in the earlier weeks. So a nice little reminder of you of a delta reversal trade. But for me, what happened here is this was a losing trade, right? And it loses for a few different reasons. All of those reasons can be grouped into either technical or psychological. Now, from the technical side of things, I wanted a short here. Market opens lower on the back of a shooting star candle that breaks the range, and now we open to the downside after a weak close to break out of the inside day to the downside. So that was the basic plan. This is going down, we're going to break this low, market's going to drop. Great, got the plan down. So the objective or the ideal entry point is in this box, somewhere between the VPOC of the previous day and the close, i.e. test back up and sell it. That's the plan. Now, we don't get a test of the box to start with. Market opens here and goes straight down, which is what's happening here. So that's one thing. What this now means is that people looking for the move down, like me, are chasing this. They're now vulnerable because rather than being in up here where they'd like to be in, they're now selling it 15, 25 ticks lower and now chasing it. So they're a long way down on this. And unless they sold it straight off the open, you're very, very quickly an additional 30 ticks down. So you're now selling it 50 ticks plus below where you'd ideally want to be in the trade. And so what happens is delta doesn't fall. Why? Because sellers are now cautious and they're trying to sell on any pullback. They're desperate to get in, but they don't want to chase. And that creates this movement down here. At the same time, delta rises, so buyers are present in the market. This then is the technical structure, the technical indications that come before that loss. Now, you don't know that they're all going to be present every time. The gap down, for example, but parts of that move you can start to look for as indications that this may well be a trade that could work. There's then a psychological part to it as well. Why was that trade missed? Quite simply, it didn't trade to where you wanted to be in. And one of the things I say so often to people is that if you don't get the trade that you're looking for, it's not a trade. The plan is to sell in the box up here, but that box up there is just up here. That's where the plan is, to sell up there. It opens and it goes down, so you can't do it. Therefore, you do not want to be short until you have another point where you can sell it from. So what ends up happening is that because this was a well-planned trade, a trade that had good scope, that looked like a nice trade that you wanted to be on, this now creates desperation. Because having not sold it straight on the open, because that didn't make sense to my plan, I'm now in a situation where I feel like I'm losing. I'm missing out on this money. This should be mine, and I don't have it. And that becomes frustrating, and that creates desperation, desire to find a reason to get into a trade. That's not a plan. That is hunting a reason to do something, and that's a different thing. And as soon as you're doing that, and if you can identify situations that you do this, there are situations where you can look and say, right, I need to step away from this trade. I need to hold back a little bit and work out what exactly I'm going to do here. So, plan was, for me, once the data comes out, if this gives me any reason to go lower, small data miss, sell it. There's your opportunity. But think about the market psychology. People are chasing this, but chasing it in a cautious manner whilst delta is going up. If that's the case, the market psychology is, unless this goes straight down, we're getting out. And that's what happens. The data comes out, market doesn't go straight down, everybody runs for the exits, which toasts all these people, trades straight back to the box, and then drops straight away. But that then becomes a trade that you don't want to take because you've just got burnt by the trade that you didn't need to be in. So that's the lessons of the trade. So how do you now turn this around and make it a winning trade, or at least make it a strategy for yourself? First up, break down the pattern of what happens. To start with, you get a directional move. So high velocity initiative move takes you away from where you've been trading. What happens next? This is the bit where the sellers chase. They've not had the chance to sell in this move because it's been quick. And it starts at a point where they didn't really want to be in and just runs away from them. So now it's basically where they wanted to be. But they wanted to be short up here, and the market's now trading down here where they ideally wanted to be. So what they start to do is cautiously sell. They don't drive it through the lows, they sell it on bounces. And the problem with selling it on bounces, or the problem with that kind of scenario, is nobody has the aggression to push it down. So they're ultimately vulnerable. They wanted to be in up here, and now they're selling it in a slow move down here. That creates a sense of sort of general market psychology of let's hope it keeps on going. Essentially, imagine, put yourself in their shoes. What are people hoping here? That it steadily drop, and then falls off a cliff. But it's only going to fall off a cliff if buyers completely clear out the way, or if sellers suddenly now take the initiative and drive this down. And that's what the data was potentially going to do and what people were hoping for. Delta's rising. This tells you that buyers are more active. Therefore, they have some strength. Wedge breaks. So anybody who's late to the party selling it down here now starts to sell it on the way back up, and they start getting pushed out of the trade because everybody who is in starts to exit. And then finally you get the acceleration because everybody who sold it below this level in the grind move, they're all offside now. Those who are not out run for the exits. Those who were on a nice winner now also have to run for the exits. There's no sellers left and the market explodes higher. So you've worked out now the phases of the move. Where the pace is, where it slows down, where the potential access point is. And so you can now turn this around into an information response. So what you're trying to do here is you're trying to say, right, well, if I see this situation, what do I do about it? How do I deal with this trade? So first up, the directional move begins. My first thought in a scenario like this, and this for me is vital to not getting myself in trouble on a trade. My first thought is, I need a pullback. If I'm going to get into this trade, I need a pullback. Not a pullback in a grind, a genuine pullback, something like that. That's what I want. If I don't get that, I don't want to be in this trade. Because I don't want to be in a market that's just steadily moving away from me. It makes it very hard to define risk. It makes it very hard to know if you're wrong. So, sellers chase the move. You don't get a pullback, you don't get to get into the trade. The main objective here is loss prevention. Do not get caught up with them. Do not fall into the trap of selling it into this little wedge. Now, this is my way of looking at it. If you're comfortable selling it in the wedge and trying to sell for the continuation down, go for it. I'm not saying it's a wrong trade. I'm saying from the way that I take a trade on, this typically doesn't work well for me. So my objective here, do not participate. This is a loss prevention strategy. Delta starts rising. Now I can start thinking about a reversal. So even though part of the loss prevention is don't get caught, and one mechanism to do that is to say look for a reversal, until I actually get an indication of it, Delta rising, now I can start thinking about a reversal and start thinking about, well, where's the access point? Once you've got the wedge, or more particularly the top side of the wedge, the downward sloping trend, now you've got an access point. Break of the trend, there's your access. So you now have a trade. Your trade's available. You just need now to get into it. You need to get to a point where you say, yep, that's the point I want in, get into the trade, and the market will then move. And then finally, the acceleration, the exit to the trade. Once all the short stops start getting hit, that is the point where you say, right, the trade is now done. So you've got a plan as to how we're going to get to here, and then you'll wait to that final exhaustion, that final jump, that says get out of the trade, there's your exit, the job is done. You don't need to look for any more than that. But what it's about is creating a response to each piece of information that you see. And in creating a response to it, it enables you to transact in a certain way, to not get caught up on certain trades, and to equally play that reversal when it becomes available. So let's go and have a little look at condensing the trade down and executing the trade. So what we're looking at here, the wedge break. I'll get this to play for you. There you go. The wedge break. What you're expecting is the order flow to be relatively steady. So this is where the wedge break comes in, just around about 40. You're thinking steady order flow until you can start getting up above 50, 55 area. Once you can do that, get through this area of low volume, then we can expect the more accelerated move towards the upside. So what you've got to be thinking about here now, the wedge is broken, the move is on. If you're not in the trade, where does your risk go? So it's about framing your risk now, planning where you can put your risk on, and then also looking at where your hurdles are in this trade. Now, in terms of where your risk can be put on, either you pay the break of the wedge and your stop can go back inside the wedge. That's the first thing you can do. But if you're not in, how else do you do it? So this is about dynamically deciding what you can do from this point in time. You don't want to just arbitrarily be buying it around 46, because that now gives you a stop down here. So we don't want that. That was nice though. You've got a bit of pace through 50. There's your indication that we're starting to get some pressure towards the upside. So that's now your chance to buy. Now with that, you've got to be looking at this. As it drops back, how far back does it come? We come back to around 47. That's all looking good. So 47, 46 and a half. That's where your stop can now be placed. That takes you back down to here, if you're going to get stopped out, just in there. So we've now established an entry point. We've got our risk defined. The top of the move comes in at around about 75. So that can be the kind of big target on this if you want to be looking for it. 75-ish is where you can be looking for. But what are we expecting order flow wise? As you're watching this, you're thinking, right, once you break the wedge, you're going to get this steady grind up, which is roughly what we've seen. Nice and steady, push, 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 push. And now we're getting more acceleration above 50. Good. Once you're beyond the top of the wedge, you're waiting for the liquidation phase. It doesn't mean it has to happen instantly. Doesn't mean the moment you break 50, boom, this is going to 75. What it means is you're expecting some kind of liquidation. This may not be all in one. This could be a steady move. This could be a tick, 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 but straight line. But it's a liquidation move you're looking for. And then your exit on the trade, you have your targets ready for one. But if you get this jump up, if you do get a stop type move, that's where you then want to say stuff, right, I'm done on the trade, no more. That's as far as it goes. Now, if that stop goes to 67, that's where you're out. If it goes to 75, 78, 90, you've already got your orders in place to get out. So whichever way it does it, you're looking for an out, either with placed orders, or you're looking for an exit on a spike, and as soon as that spike stalls, there you're out of the trade. So it's kind of a hit market against the stops type trade. So that's the kind of way to try and play it. It's about them stepping through each phase of the trade, and you're just condensing the information. You're not trying to be really specific all the time. You're trying to go, right, we're there. That means we've got this. Wedge break, done. Have I framed my risk? Yes. Do I know where the hurdle is? Yes. Is the hurdle changing slightly? Arguably, yes, 55. Now we're above 55, all good. What do I expect the order flow to be? Grind, jump. Okay, so we've got that bit nailed down. I know what to expect at all of these phases. So it's not now a job of trying to judge every last bit of the movement and does it mean this, does it mean that? You're saying to yourself, this move's on now. You've seen all of the information that is needed. The move is available. You're waiting for this to happen, basically. So you're in a nice position down here. You're happy with this. Just scaled something out at 61. That comes on the back of it getting into this first area where you had some volume. Stops go off. Boom. Trade is done and you're out. That's what we're after. It's about having this clearly condensed down, broken down. You know exactly where you are. You know exactly what you want to do in that situation. That's how you turn a loser into a winner. That is that delta reversal trade. There's your delta going up. There's new lows with rising delta. Wedge break, grind, jump. That's exactly what you're after on the trade. But all of that for me came from basically in the past, this isn't the same trade. And this is where you turn it around. A move that looked like that, followed by a grindy move, and then getting caught on the reversal in that way. Having learnt that trade and having seen that, taken that hit in the face, I'm then able to turn that around. Think about it in the long term. Over the long term, that recovers itself. I've saved myself on that trade because I've learned how to trade the opposite way. In some circumstances, you just simply don't get the chance to trade it, and it does do what the sellers are looking for. But if it doesn't, I know I've got an opportunity, and I'm happy to take this trade on. When you're adding to the criteria of a trade like this as well, think about what's going on within the day. What are the implications of the whole day? Have you already started a trend day? Because that's where if you've already started a trend day, it might be more tricky to reverse. If you've already started a trend from a sort of solid base, they're the ones that are harder to reverse. This one, not. Trading sideways, drops out of the range. We're already in a kind of non-directional opening range anyway. This is midday as well, so it's quite a long way in. Let's trade. Generally non-directional market, falls out of it, unlikely to keep going. It's kind of an elastic band trade as well, but that's a circumstance that fits into this trade specifically at the time. But all of that information stacks up to say, yep, that trade is on. What we're going to go and have a look at now is pattern matching. How do you develop trade ideas, not on specific setup versions, but develop trade ideas over a more wide basis? What you're trying to do here is identify when the time is, when the day is for the move, and how you can spot that and then try and take that trade on. So it's about trying to find trades within a wider structure. That's what we're going to go on to next. I'll see you there. All right then, pattern matching. What we're looking at here then is to try and identify patterns over time, and we're going to look at different guises of them. We're going to look at patterns relating to environment. So to try and identify a sort of structure pattern going into, say, an event, or a structure pattern in a sequence of movement. We're then also going to look at new information patterns. How do you break down new information to give you potentially a new trade? So reverse engineering the action that's just happened. And then also specific event patterns. So reverse engineering those. The idea behind this is more than just simply working out a setup. What you're trying to do is you're trying to identify a pattern of movement. So more of a wider structure type action. You're trying to identify the characteristics of any move so that you can then define how do you take that on as a trade? How do you play that as a specific trade? So let's go and have a look at two different ways to go about pattern matching. There's two routes. One is you go inventory. So what you're trying to do here is you're trying to create a clear inventory of patterns in a chronological order. Now, one of the best ways to do this is to do it via a spreadsheet and keep a track of certain metrics on the day. This way, you're able to then, rather than just simply looking at any day and saying, okay, that was a trend day, you can then look at the day from various other metrics and find other trends that are specifically the same. Rather than seeing every trend day as the same, you're being more refined. You're being more detailed in your analysis. And so by creating a chronological log of what's happened, this does two things. One, it provides the ability to say, look at a certain type of day and then look at other days that have got the exact same additional characteristics with them. So it gives the ability to match in a more refined way. What it also does is it will form patterns within the inventory of patterns. You will start to see that there are often sequences of action that come. And being able to identify those sequences of action can then enable you to not predict the next stage, but be able to lean towards a certain outcome more so than another. And often that gives you a big edge and a big advantage, because only those who are seeing the sequence run up to something are those who are already looking for a move as it starts to happen. And typically these are the moves that seem to come out of nowhere, yet some people seem to have a canny ability to be on them. And the reason they do is because they've seen the sequence of events that lead into these. They've seen that certain types of patterns come on the back of certain types of movement. So that's the way that you can do it via a pattern inventory. And the idea being that what you're then trying to do is you're trying to pull from this an expectation of a future day, an expectation of what tomorrow might be like, and then you can use skill sets that you've already got, going back to original sort of basic strategy development, use those and plug them in to the pattern that you're looking for, so that you're then looking for a certain style of trade and certain type of trade that aligns with the next day that you're expecting to be playing or be trading. An alternate way to do it is reverse engineering. And this is much like we've done with some of the earlier stage, but it's about looking at a specific pattern within a day. So you see something, and then it's about going through this and asking yourself, well, what just happened? What were the characteristics of this move? It's not about a setup in the sense of it being a technical pattern. What was the characteristic? When did it happen? What did it do? What then happened? And so looking at the sequence of events, and that's the real thing with pattern matching. It's not about trying to be precise on the chart pattern as such. It's about trying to be clear on what the sequence of events are. So if you see this, then this, then this, you can look for this. Rather than you look for a pattern, you see a pattern that provides a trade. And that's not a bad thing. But that's a skill set that allows you then to play some of these other wider sort of pattern matched ideas. What you're then trying to do is work out, well, how do you play this trade? What part of the trade is worth playing, is playable? And we'll look at this as an example using a very short-term piece of information, new trade, and we'll also look at it as a more sequenced information over time and trying to pinpoint the different areas in which you can take this trade on. So let's get on to it. One of the ways to do it, like I said, is to create some degree or some kind of chronological pattern match. So what you want is comparable metrics. So each day you want to be taking note of certain information. Do we have any events on the day? And those events, this is to illustrate the kind of way of noting these things down rather than this is an example. We'll come to an example in a moment. So things to get down. What's going on event-wise? Do you have any data? Do you have any central bank commentary, central bank decision, OPEC meetings, any theme-based news, any general new information coming into market? So that's your kind of more subjective bit of info there. Things that have happened that help you understand the wider narrative. What it also helps you with when you're debriefing is recalling that day. If you know that this was a day that had an OPEC comment, or you know that this was a day where the United Kingdom mini budget was, then it brings back memories. You know what that type of day was like. What I really want to be tracking is volume. I'd have this highlighted. Get your highlights in for different things. So high volume and rising, high volume falling, low volume rising, low volume falling, average rising, average falling. So you've got direction and you've got a sense as to whether this is a lot or not. Likewise, delta. Flat, it can either be positive, negative, extreme positive, or extreme negative. So again, are we getting beyond, and for those of you who watch delta and look at the kind of standardized range for most markets, when I'm suggesting extreme, I'm looking for it to come out of those ranges. Direction. How's the market traded? This gives you an indication as to the type of day that it is. You can get down the type of day that we're on anyway, but the way that this trades, which captures all, as well as how the market is moving. Is this a breakout? Because you could have a trend move that isn't a breakout move. It's a trend within a range. Is it a one time framing break, a two time framing break? Is it a sort of choppy break, or is this a straight line break? Same, one time frame versus two time frame in a range, one time frame versus two time frame continuation. So you could have a one time frame continuation, which would likely be a trend day that follows a trend day perhaps. Volatility. Track the type of volatility you've got so that you can then go and look at, perhaps for example, every trend day that exhibits high rising volume, flat delta, it's a breakout trend and it's in high volatility. Is that something that's actually typical? Does that ever happen? And you might start noticing there's certain scenarios that just don't generally happen, that every trend day has certain aspects to it. You can then also track trades that you took on, opportunities that were available, so that you're also able to say, right, well, in this situation, if I see this type of trade with this type of volume, these are the available trades. This is what you can do on days like that. So you then start to match strategies that you have, certain setups you have, to the type of day that you're trading. So this is basically the formation of, or the organization to allow you to start to look for patterns. So you can start looking for sequences of days, start investigating different sort of patterns within the overall pattern. Do you get certain types of action following a trend? What happens if you get a trend, then another trend? What's the general sequence of action that can happen there? So you can start from any point. Typically, you might then use a point like a breakout day as the beginning of looking at a sequence of action after that, because that's a changing point. Do you get certain trades as well that relate to a specific day type? Do you have more or less trades on certain days as well? So this then makes your life a lot easier in managing expectations. If you know that typically you don't get many trade opportunities on balance type days, then straight away you can limit your expectations. You're gonna have less chances, and those chances are gonna yield less on them as well. So straight away you can hold back a little bit on them. You can isolate specific situations as well. You can isolate all of the data type days and go and look at the day that has data on it and look at what the sequence was up to that day. So your sequences that you can look for can start from an action and then the follow-on sequence, or you can start from a result of a piece of data and how the market moved into it, so that you can understand that the result of that data also can come on the back of a certain sequence of action. And that's in fact what we're going to go and have a little look at now. So it allows you to vary things and constantly start to look for new ideas. As a source of ideas, something along these lines is fantastic. It constantly gives you new ways of looking at things and new patterns. So this is a realistic version. This is something that happened in September 2022. And this is looking at the S&P in the run up to CPI data. At the time, we're in an environment where CPI is extremely volatile. CPI has huge scope for movement because the environment relates to inflation and the Fed's reaction to inflation. So every CPI data potentially is an indication as to what the Fed is going to do next. This is a big deal then. You can look at the action on the CPI day in view of what's happened on the previous days. So you can look at the lead into this with the ability to then have an expectation as to the scope of movement on the CPI. So what we end up with is looking at the way the previous days have played out. We've seen that order continuation is lacking volume. It remains low, but delta's starting to turn negative. So you're looking at leading indicators, for example, here. That in the move up to this, we've gone balance, trend, normal day, normal variation day, balance. And in the lead up to this, what we've seen is a consistent drop in volume. We've seen delta not really changing at all, but you now have a trend day with positive delta. And that's roughly as one might expect. You could go and look for many other trend days and find that. And you'd be able to say, well, that's a pretty standard type action. It's a one-time framing break. Yep, pretty standard. It's a trend to the upside, lower volatility. Okay, so all that makes rough sense. Where you get in some information is the fact that what you start to see is that volatility is reducing still. Delta's not changing. Volume is consistently falling until you get this shift, balance day. You now have a balance day, which if you're seeing falling volume, one would assume that it's going to continue to fall. But instead it starts to rise. And what's also important in the rise is negative delta. So you now have, on the back of a movement higher, negative delta in low volatility and rising volume. That says there is a bit of potential in this move now. So basically you have a market that has moved up and stagnated. And when you look at the chart that matches up with it, you can really see what's happening here as well, which we'll go and have a little look at in a moment. So you're lacking trend higher. Once you have the trend, which is your breakout, everything else is just a steady continuation. Even during the ECB, volume is still pretty average. And it's just continuation type movement. Volatility is higher, but that volatility is a symptom of the ECB. And then you get the trend move. High volume and rising, negative delta. It's a breakout, very high volatility. But that could well be a symptom of what's come before. And it's the sort of squashing of volatility, the squashing of volumes that provides the opening for that explosive move. So this is what you then get. This was the day after payrolls. Sorry, was that the day after payrolls? Yes, that's the day after payrolls. So that's the Monday following payrolls. So Monday following payrolls. Volume's not bad. Then you end up with the move higher. Sideways action, normal day, normal variation or balancing type day. And then you get the big drop. Look at the volumes here, volume here. Very light, but delta not looking good. This one has weakening, actual lower delta. These ones all turn towards the downside. So the only time that you get rising delta is on this trendy looking day. And when you look at the day itself, it's not exactly the strongest of trend days. The ECB creates a volatile balance day, and then you have that movement onwards from there. Not a great deal going on. CPI then, you're going into this with the view that you can see the grind move, but you can see now more than just, because it's easy in hindsight to go, oh yeah, well, we ground up into CPI. Of course this had the scope to drop. And of course you can say that. But what was it in the characteristics of the move that could help you understand the scope of the drop? That's what it's all about. It's not just about being able to say it was going to drop. Because for most people, it's still going to be hard, even if you've looked at this and said, well, that can drop. On CPI, to look for a move of 200 handles, many people are going to look at that and say, nah, not on. You're not going to get that type of move on a CPI data. But if you can see this pattern going into it, you can see reason to believe that that is a viable trade, because you've seen in particular, moving into it, that drop of delta. These big drops in delta are the thing that makes you think, I'm not convinced of this. The delta dropping, even though volume's low. So you've got this low volume, but delta is still dropping quite hard. It's not really dropping loads, but it cannot stay up and it gets turned over, particularly in the cash session, very quickly. Delta going into the cash session is up here. It's a drop for the entirety. It's a drop for the entirety of the cash session. That's where the problems lie, and that people are willing to sell this. And so then, come the cash open, the sell-off continues in the S&P, which is what you're seeing there. Continues onwards, people are willing to sell, and you've got all of that space to go down. The point here being that what you can now do is you can go, right, well, I've seen this, and because you've created a much clearer sequence, this isn't just it ground up into CPI and then it dropped. You've got a sequence of action. It also improves your ability to recall this. If you've gone through this sequencing process, your ability to remember what happened here is going to be much, much higher. I would guess even from now, if you go and look at CPIs over the last 3 months, you're going to have a better memory of what happened on September 2022 CPI than you might well have of the last 3. Reason being, we've talked through the sequence. And this is a memory that will probably stick more as well, because the sequence is not just, it went up and then it dropped. The sequence has stages. It has steps in it. And so you understand what's happened throughout that sequence and throughout the movement. That's really valuable. That's crucial. And that then helps you identify similar situations to this. And if you see a situation similar to this in future, you're then able to more confidently believe that if you start to get a reason to drop, this is going to drop. And it can go a lot further than you might typically expect because you can understand the scope of that movement. One other thing that you want to be trying to do, and we talked about this at the very beginning, and this is a good way to bring us in towards the end of the course as well. Breaking stuff down into different environments, as in, most strategies will be able to work in every environment, but what environments suit certain strategies? Breakouts, for example, the obvious one. That playing a breakout, playing a sell it into the lows, is often a trade that most people like. It's certainly a trade that I'm a big fan of, but you have to look at the environment this is going to work in. This is not something that is going to work in a low volatility environment. A low correlation, low volatility environment. It is something that works very nicely in a high volatility environment. It is something that can also work in an independent state environment because there's nothing else to get in the way of it. When you have high correlation, it has conditions. Playing breakouts in high correlation markets, where 2 or 3 markets are all moving together, can work and can work nicely. But you need to see the other markets also at a point to break or at a point to drive in one direction. So there's more contingency required. So it's about being able to say, right, well, in this certain situation, what more information do I need? Event-driven markets, what are the appropriate trades here? Typically, in an event-driven market, one of the things that is required is the ability to upsize quickly and reduce size quickly. So more variation in size, more smoking chimney type trades happen in event-driven markets. That's something that you can start to look for. And what you're trying to do is you're not trying to put in probabilities of certain things trading, of certain things happening. You're not trying to say, I've got a higher probability of seeing this in a certain type of market. What you're trying to say is there is a greater propensity for this to happen. Stop moves, greater propensity for those types of things to happen in high volatility markets. To see a volatility stop is more likely, has a greater propensity in a event-driven market where you get these sudden changes of news. Seeing a flipper, trading flippers, low volatility. That's your ideal scenario and your ideal place to go and look for somebody flipping markets, to look for those simple sort of order flow type scalps. So it's not about saying these strategies only work in these types of environments. You're saying there is in certain type of environment a greater propensity to see certain strategies. And that way you can be more confident to take on certain strategies, more comfortable with certain plays than in other types of environment. As I've said before, in terms of quantifying environment, the key way to do this, and that is why when you're chronologically tracking things, you want to mark down the type of volatility of what's happening, mark down the events, because that's where you can start to assign environment. You could even, as one of your columns, have each different environment in. And so as a way of developing strategy is to also develop a kind of a way that you see different environments. Now, high volatility, whilst you can try and define it and say, okay, well, if the VIX gets over, say, 40, that's high volatility. For some people, they're going to look at that and say, that's extreme volatility. It's too much for me. I don't want to be part of it. So that would be one way that they could play it, or they would see high volatility as a slightly lower metric, which then allows them to say, this is what I do in a high volatility market, and then arguably they have an extra step, which is extreme volatility, and they don't trade that. So there is, these things are these are qualifications and ways that you have to qualify what's going on yourself. The rough things that will happen in these types of environments are consistent. Higher volatility, you get faster moves, bigger moves, more frequent opportunities. Event moves, the action is sporadic and then has periods where the news is erratic and can be costly. Independent state markets, these are generally the more technically orientated markets, ones where you can get your chart out and trade off that because nothing else is affecting your market. High correlation, what is correlating? What is driving the moves? What is the leader in the correlation? And then being able to play correlated plays that as one breaks, they take each other with it. Or if you have one market extending a range and nothing going with it, you have a reversal trade. So how do you take these types of moves on? What do you do when there's no low correlation? When markets kind of move together, but they don't move clearly together? How do you deal with that? Low volatility, what types of trades are there? Is it simply a case that you dismiss trades because volume drops too far and you say this isn't an environment I want to be in because it becomes erratic? Or do you see that as a chance then to just get into a trade and play for a sort of steady reversal type move? So it's about understanding the types of trades that you can take in those different environments. So that's a chronological version. What we're going to look at here is an example of new information. Something happens, you see this, you break it down quickly, and you can then look at the characteristics of what happens here and try and see if you get something similar in the coming days. I'm a big fan of, and I've seen this consistently over time, you see something happen one day, particularly if it is very distinct time-wise as well, you will often get very similar movement in the subsequent days and weeks. It may not be the next day, but you can start to look out for that type of action in the coming days. So, what you're looking for is something that is quite distinct. It's not trying to find some kind of vague pattern, it's something quite distinct. If it happens at a specific time, even better. So what you're trying to do is break down the information and you're trying to form a prediction. Now, humans don't need a huge amount of information to be able to form a prediction. That's the way humans work patterns out. You need a piece of information that gives you the ability to say, this is the inputs, if I see this, this, and this, I can assume that this might happen. If that starts to happen again, you can assume that your prediction is now correct and you can trade that. That's the way humans do it. You don't have to backtest this, Miles. You don't have to work out some long-winded version of data to do this. This is something, you see something happen, you work out the characteristics of what happens in that situation, and you can trade off the back of it. So what we have then is a small initial balance inside the range, below value and below the close. So down here, and down here. Slightly bigger initial balance on this one, but still not exactly huge. Certainly not anything compared to these initial balances over here. So that's the first thing. You then get high velocity IV break, straight on the cash open. This is the bit that is distinctive and also time specific. This makes it easy to identify in future, and it makes it easy to then look for the sequence of action that comes after. So with so many sort of sequence or patterns, there will be a trigger. Something happens and that then kicks off the pattern. You get sticky order flow after the first drop. So the market struggles to keep the move going. You see absorption begin. You then get a break of consolidation and a reversal. And the reversal comes fast, and in the first instance, fast and back through the initial balance. Wider context is always worth having, and wider context, we're mid-range, we've had a weekly liquidation move higher, but we're ultimately then sitting in a sideways range. But note, none of this talks about specific chart patterns, any candlestick patterns or a flag or anything like that. What we're looking at here is the sequence of action. What happens? How does it move? How does it do what it does? That's the bit that we're interested in. So what I'm going to let you guys have a go at doing, and we will cover this then when we move into strategy life cycle, because what's really important to understand is how this trade develops over time and why it develops in a certain way that it does. But you can go and have a go at this. Go and replay and look for those characteristics in the movement, and pointedly, as part of your learning for when we do strategy life cycle, is to try and identify what changes within the different patterns. So go and have a go at it. Look at March 2021, the 22nd, 23rd, 24th and 25th of March. you're trading from the cash open, do be aware of time change here, that it may well be that the time change affects the replay in the sense that you might have to put 9 o'clock or 7 o'clock as your start time. But bear in mind, you're going to, of course, have to vary this by what country you are trading in. But have a go at that. Look at how to execute the trade. Now, of course, you know the basics of it from what I've just explained. But what you want to be focusing on is how do you execute the trade? What is the realistic trade opportunity? Of course, you know that it's going to go down on the cash open, but ask yourself, is that actually a trade? And if it is, how do you play that? Because the first time you, of course, can't know that that's a trade to sell it straight on the cash open. But what happens? So you look at the characteristics of the movement rather than just straight up what are the chart patterns that go along with it. We're looking at those moves just there. That's the bit that you're interested in. 22nd, 3rd, 4th, and 25th. They're the ones that we're interested in. Go and have a go at trading them. This just gives you a bit of a chart indication of what happens. And this then helps you identify the differences between them. Some of the things that you're looking for in characteristic then, and this when you're trying to break down any pattern, you're trying to go through what happens, what are the characteristics, and how do you play this trade. So if we start with the first one. First move, high volume break. Market rips to the downside. The volume drops off quickly. Delta flattens. Market trades sideways. This is quite a structured move. But it gets this sideways consolidation. You get the break of the consolidation to the upside and then a liquidation. It's basically a block reversal, very short term. You get the spike up in delta, which is as it comes out of the range, and then you get this rip straight the way back through the IB. So there's your characteristics. Fast drop, stagnation, delta turns over, liquidation. Look at the average volume there. Very, very light at this time, basically indicating a market that does not have the scope to keep on going. So next up, same thing. IB breaks, nice and quick, high velocity break, volumes stay high. So there are differences here, but the general move is the same. Down it goes, struggle, back up. So you're then looking at, well, how do you play that? What happens within this? Here, delta flips up and then the market reverses. So how do you play the different parts of the trade? How do you identify the reversal? Because with this one, the reversal is pretty obvious when you leave the block. With this one, it changes. And that's what I want you guys to be thinking about in terms of how you're looking at it. How do you approach this second trade? And then equally with the third one, the drop straight on the cash open. Boom. There's your one opportunity potentially. How do you play that? And it's about then asking yourself, how do you play each phase? How do you play the move down? How do you identify the turn? And how do you play the move back? What are your expectations within the move? As it happens, how do you expect it to do it? And so then, again, same principle, but look here, the delta turns first. Delta starts to turn up, even whilst the market is going down. So you're then looking at this thinking, well, there is a chance for a reversal. I've just got to find this. And then you get this quick reversal. Can you play that? Is there a way of trading this? Or how do you play the second part of the phase, the second part of the move? It's about trying to break your pattern down in that way. Like I say, we're going to talk this one through and I'll show you the replays of this when we do strategy life cycle, because you need to understand how this shifts and why strategies change, develop, and then die, or adapt, shift, resurrect themselves in certain circumstances. So we're going to go and look at that in the future sessions. But one of the things I really want to show is get you guys to actually trade it yourself and try and identify the differences in each of them, how it changes, how your execution shifts, or at least how the movement happens and how you can execute on that. So this is the whole sequence of action. It happens here. And so from a much wider perspective, is this something that you can actually be trading to give yourself information about this? One of the things that I'm looking for here, is if I get this situation again, because you go into the effort of sequencing it through, working the trade out, if you see this spike down, and then failure to go down, what that's telling me, and what you're learning from those opens, is that sellers may be willing to try it, but they're never able to gain traction. This then helps that the moment you see that sellers don't sell it on the open, that gives open space for buyers. And that's my kind of thought process in it. I'm not just thinking about this trade here, I'm thinking about the bigger game of what this means, of when buyers are going to be confident to go straight for it from the open. Because when buyers become confident to go long early on, sellers are going to get out of the way of this quick. They try it and try it and try it, and it doesn't go down. Do they still want to sell this if it starts going up? No. This then opens up that type of movement, and you get this more trendy like move. So again, that doesn't necessarily have to be something that you can back test and prove, but that is a prediction, and it is a way of saying, right, if I see this situation again, I have now a template for this type of movement. I have an expectation that when we fail to do the move down, I'm going to play for this, I can commit to it, and I'm going to believe that this has bigger scope, and you can play for that move. That's how some people, or a lot of people, are able to sort of spot moves before they happen, or be on a trade, or as it starts to go, seemingly out of nowhere with little indication. It's about the sequence, the events that come into this. So it's not just that one small event at the beginning of the day, it's the implication of that going forward. Right, final thing, looking at specific events. So this is then trying to look at the sequence of movement into an event and out of an event. These are easier to identify because they're time sensitive. You can do this onto data points, you can do this around bond auctions, which does require a little bit more understanding of the environment because bond auctions vary by environment. You can do it with option expiry, which is what we're going to go and have a look at here. And this is about reverse engineering a move. So you can then use an event as your pinnacle and then look at the sequence of action before it and the sequence of action after it, and try and then find some pattern in this. That's what we're going to go and have a quick look at now. So you need to define a trigger to start this. With something like option expiry, this is reasonably easy because the volumes and volatility changes the week ahead of option expiry, particularly on quarterlies, because this is where contracts are rolled over as well. You can now start looking for this trade, and you can view not just the option expiry day as the trade, you can view the whole week ahead and the whole week after as your lead in and your run out of that event as well. So that's the idea of widening your scope. Now, this is a kind of experimental process of saying, right, well, is there anything in those previous patterns? But by going through and categorizing the pattern, you give yourself at least a framework to then look for similar things. And you might not find anything, but it's giving you that ability to find something. That's the crucial part of it. And so then you're looking for patterns post the event as well. Are there consistent movements after that? Key bit here, work out the phases. Work out the phases of the action, and you're looking basically to find the bits of it that you can trade. Your objective here is not to go, right, this is the pattern and I'm going to trade it. For example, this option expiry play basically does this. Now, you're not saying, right, Monday before option expiry, sell. Option expiry day, buy. Get back to the original place, sell. It's not that simple. But in understanding the context and the pattern, what you're able to do is identify specific areas where there are high value trades that are likely to move in a certain way because of the wider pattern, and allow you to define risk very, very clearly. That's the crucial bit of it. So this is why you're working out the sequences of it. You're trying to find identifiable trades and trades that you can take on. Structure of the whole movement. Is the time sensitivity to this as well? When I mean time sensitivity, are you running out of time for certain things to happen? With something like an option expiry move, there clearly is. There's the option expiry. So if the action doesn't happen into that, and you don't see that move, then that allows you to just step away from the idea. And like with many event type moves, there is time sensitivity. It has to do something before the event to make that significant on the event. So it does come down to that asking question about what bit of it is playable. When is your trade clear? When can you say, this is absolutely what I want, I'm playing it? And then what are your expectations? Do you need a certain sequence of event to be able to play a certain trade? Or is the setup that you get post an option expiry always a potential play? So let's go and have a little look at this. This is something that came throughout 2021 and I'm sure many people know about this type of trade, the dip to the 50 moving average, which also coincided very clearly with option expiry and became more and more distinct as you went through the summer months. So that's one thing to note. Could this be a summer month option expiry play more so than other months? Again, doesn't have to be, but this is using your ability to predict something forward and to identify when you're going to be able to find that out. So you've got to get into the details of this. And if we go back and look at the August option expiry then, which is this one here, the final one, what happens? And you can then go back through them. You're trying to work out, this is the option expiry day, the last day of the week. What happens within this? A sequence of action. Now, one of the key things that happens is volume rises into it and falls out of it. That's one key aspect of the sequence. You're also looking at the sequence of movement to start with. One of the things that I'm always looking for at the beginning of option expiry week is increase in volatility, but not necessarily any shift in direction. That's a first indication. Now, of course, that doesn't mean anything. Increased volatility could go up, could go down. But what it does is it alerts you that this is potentially becoming something that you may well have seen before. You get a sell-off and that fails. Now, in the first instance, you see that and think, okay, not much to it. But does this become something? You're trying to identify the characteristics so that in future, this may become a characteristic. It might not. That might be an absolute nothing. And you don't get anything from this, and that means nothing. But if you do see a sequence where sell-off, fail, second wave, that now becomes partly a playable trade, because this identifies the potential of that. So you're always looking one step ahead. Once you get this, and the first part of this trade for me was about spotting the option expiry and then saying to yourself, right, how do I trade the actual option expiry from the S&P Open? And that came down to, once I'd seen this pattern, it was thinking, well, you've got this kind of base pattern now. You're looking for the reversal, you're looking for the continuation. So that's the basics of the pattern, that you get chop, drop, base, reversal, continuation. Has a very sort of rough part to the trade. So what bits of it can you actually play? How do you go about it? This is what it starts to look like from a profile as well. So you've got these clear profiles, very, very small. They immediately get more erratic at the beginning of the week. Then you get option expiry day and reversal day. So it rallies on the option expiry. Is that consistent? But one of the things you can look for is the rally. We know that this drops and bounces, so you know there's a rally in this. So you can then look at the playable part of how do you play that move. This comes to start being a very, very aggressive acceleration move straight off the open. That's the play. Open, drive out of this block formed in the overnight session, acceleration and continuation towards the upside. So that's the bit of the trade that you're after. People are ready for it and they immediately get onto this trade. You go and look at the July one as well, same thing. Volume rises, even though direction is limited. Volume then falls post the option expiry. So the sequence is the same, but the sequence in days is not. The beginning of the week starts choppy. You get the failure down and up, which identifies the possibility of the second wave. So there's your break, second wave move. That's playable. But note, it's not on the option expiry day, which is this day, that you get the reversal. Instead, what you have here is a move down, bounce, base, reversal, and then the following day, continuation. So you do have the same trade. It's about saying, well, which part of this is tradable? That's the tradable bit, the reversal bit, and the drop bit here. They're the bits that you're looking for because they follow a sequence of action. The volatility or lack of volatility, but sort of choppy trade says, well, there's something here. Then you get the drop and fail. You can play a second wave. Base, you can play the reversal, but you need the drop to form the base. The volume shift, exactly the same as previous. That's the beginning of the week. A little bit of increase in volatility. Option expiry day drops, gap down, then you get the reversal. But the reversal, crucially, once again, comes from an extremely fast, high volume open. The high volume open breaks a rangy overnight trade and explodes towards the upside. And this pattern's exactly the same in June. Choppy starts the week, volume's flat, volume does jump on the Fed, but after that, volume then starts to tail off once you pass the option expiry. Drop and fail, second wave, base, going into the cash open on the Monday or Tuesday after option expiry, you're looking for this very distinct, ultra aggressive bid. And when you get that, you've got a trade on it. And that's what you're then after. That's the profile of the June one. Same kind of thing. You see it has these very large initial balance. So you know that post option expiry, if you get this stagnant move, drop, you're waiting for the day that you're expecting one of these days is going to give you roughly an open drive, very large, strong initial balance. Again, same principle. This is what you get. Explosive initial balance, high volume, drive higher. And so the part of the trade that is absolutely playable is that drive on the open. That's the bit that you're interested in. And so what you're trying to do with these types of trades is you're trying to work out a sequence of patterns so that it's not just about going, right, we are here, 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 and here. It's about being able to identify patterns and say, right, there are certain playable aspects to this. There are certain bits of this that I want to be trading. So you get the quiet early phase. Volume may start to build, but generally you're going to be quite choppy and non-directional. You get the first sell-off. This is what the alert is. This is the one that says, maybe this looks like previous. And the key bit to it is the fail higher and then your second wave move. That's the bit now where the identification of an opportunity comes from. Possible playable move to the downside, but also suggests that this is a viable move, that explosive open is something that could happen. Then you get a base formed, which is what goes on at 5, just here. Now you get the reversal day. This is a day where the low is formed in the IB, the market explodes towards the upside. So this tells you straight away the way that you need to try and take the trade on. You've got to be aggressive, you've got to be bold, and you've got to be willing to go for this at the beginning of the day. Once you have that, that's everything you need. That's the one that you can go for. That's the one that you can be aggressive on. And so basically it all comes down to 0.6 is where the opportunity comes. This is a week's worth of monitoring. Doesn't mean don't trade, don't do anything in here. But that whole sequence is a week's worth of pattern that says to you, this is the trade, you can go for it. That's what you're looking to try and do here. Play that move up, and then you get a similar, more muted version of this on the second continuation day. So you get the big liquidation drive, then you get the second continuation day, and then typically a steady grind on from there. The point here with this pattern matching is you now have a sequence of events going into any option expiry. If it starts to look like this by 0.34, you could assume that you're going to get 0.6 opportunity coming up in the coming days. That's where the value is, because you're already seeing this chance before it's there. That's how you get yourself an edge and stay ahead of other people, because they're not seeing that. They may see this trade, but they don't know precisely when to look for it, meaning that they're always after you. They're always behind the curve on it. That's the thing to remember. That's where pattern matching is so valuable. So get onto it, start tracking patterns, start then reverse engineering patterns. I'll see you on the next section.